Welcome to the Deep Dive, your shortcut to being truly well-informed.
Glad to be here.
Today, we're cutting through the noise, digging into Stevanato Group's second quarter 2025 earnings call.
Right. A really interesting one for a key player in bio-pharma solutions.
Our mission, as always, is to help you quickly grasp what truly matters in this latest update.
And there was definitely some stuff that mattered, especially how the market reacted.
Yeah, you might have noticed that big shift in sentiment right after the announcement, even though, the results look pretty strong on the surface.
Objectively strong, yeah.
So we'll unpack why that might be and what their whole strategic roadmap signals for the future.
It was definitely a fascinating quarter to watch, especially that initial market reaction, like you said. Because, on paper, Stevanato Group really delivered. They're not just growing, they're positioning themselves strategically. Very specialized future ahead, it seems.
Absolutely. So let's just hit that result snapshot first. Stevanato Group reported a genuinely solid Q2 2025. They didn't just meet expectations, they actually beat analyst forecasts. Both GAAP diluted EPS and adjusted diluted EPS came in at 0.11.
That's a penny beat against consensus for both.
Right. And revenue also beat forecasts, hitting $280.0 million. That's an $11.8 million beat.
Which works out to 8% year-over-year growth. Or, maybe more importantly, 10% on a constant currency basis shows the underlying strength.
And it wasn't just the top line, was it?
No, not at all. The Bio-pharmaceutical and Diagnostic Solutions segment, BDS, that was a key driver, grew a solid 10%. The engineering segment, though, saw a slight dip, about 2%.
We'll probably circle back to that.
Yeah, we should. But what's really striking, and maybe got overlooked in that initial reaction, is the margin expansion across the board.
Tell me about that.
Well, gross margin increased by 210 basis points, so 2.1 percentage points, up to 28.1%.
Significant.
And adjusted operating margin rose to 15.5%. Adjusted EBITDA hit $65.1 million, which is a 23.2% margin.
So strong operational improvements then.
Definitely. Which makes the markets, caution and that share price drop afterwards all the more intriguing. It's like investors were maybe looking past the numbers for something else.
Okay, so the headlines, the operational efficiency clearly pointing up. But let's go deeper. Beyond that snapshot, what's really underpinning this performance in their financials and day-to-day ops?
Right. Well, that overall revenue growth, the 8% or 10% constant currency, reaching $280 million, that's not just like a one-off. It really does show underlying strength.
Okay.
And the BDS segment, which grew 10%, it's clearly riding some big secular tailwinds in biopharma.
So things like advanced biologics, self-administration therapies.
Exactly. This isn't just growth for growth's sake. Stevanato is kind of cementing its role there, becoming a partner for the cutting-edge stuff, less vulnerable to, say, generic cycles.
That makes sense. That's a strong strategic point.
Okay.
But you mentioned the engineering segment's dip. How much should we read into that 2% decline?
Well, it's important context for sure. That dip to $36.5 million, management chalked it up to two main things. One, a higher mix of older legacy projects wrapping up. And two, maybe more crucially, a timing shift. Some new orders expected in Q2 got pushed into the second half of the year.
Timing. So not lost business.
That's what they emphasize. Yeah, not lost negotiations, just delayed. So it suggests the core demand for their assembly and inspection tech is still there. It's just, the project nature of it can be a bit lumpy sometimes.
Right. Quarter to quarter variations.
Exactly. A timing issue, not a fundamental demand issue, seems to be the message.
Got it. And speaking of strategy, a really central theme for them has been this pivot towards high-value solutions, or HVS. What did we learn about that this quarter? Why is it so critical?
Yeah, the HVS pivot. This is where the long-term story gets really compelling, and it's definitely accelerating. You can see it in the numbers.
How so?
HVS now makes up a pretty significant 42% of total revenue. That's $116.8 million in the quarter.
Wow, 42%.
And it grew 13% year over year. That's faster than the overall business.
So it's driving the growth and the mix shift?
Precisely. And this isn't just about chasing higher margins, though HVS products do typically have better margins. It's also strategic de-risking,
How do you mean?
Moving from more commoditized glass vials, maybe, towards highly specialized stuff like pre-filled syringes, cartridges, things where the tech, the quality, the IP creates stickier customer relationships, a wider moat, basically.
Makes sense. What specific products are driving that HVS growth?
It's mainly their high-performance prefilled syringes, things like their Nexa and Albatech, and also the growing use of their easy fill cartridges and vials. Ready-to-use formats are huge.
And Biologics demand is fueling this.
Absolutely key. Biologics represented 39% of the BDS revenue in the first half of 2025. That's a big jump from just 25% in fiscal 2023.
Okay, so that shows real execution on that strategic shift. They're not just talking about it.
Exactly. They're becoming sort of irreplaceable in the supply chain for these advanced therapies.
So they're not just grabbing share, they're grabbing the right share in the more valuable, stickier parts of the market. And this feeds back into those margins we talked about.
Directly. That favorable HVS mix plus getting better scale at their newer factories, that's what drove the margin expansion.
Remind me of those numbers again.
Yeah, gross margin up 2.1 percentage points to 28.1%. Operating margin even stronger, up 4 percentage points to 14.8%.
Wow.
And the adjusted operating margin hit 15.5%. They also mentioned cost management efforts from last year helping out too, so it's both mix and efficiency.
It all flows down.
Right down. Adjusted EBITDA reached $65.1 million. That's a 23.2% margin, up 2.4 percentage points year over year.
Okay, strong profit performance. How is this translating into cash, especially with all the investment they're doing in new plants?
Yeah, good question. Even free cash flow looked much better. It was still negative, but only negative $13.0 million in Q2. Compared to negative $46.1 million in the same quarter last year. So a big improvement.
What drove that improvement?
Mainly higher operating cash flow, plus they kept capital expenditures managed at around $69.1 million for the quarter.
And their balance sheet. Cash, debt.
They ended the quarter with $94.2 million in cash and equivalents and about $312.4 million in net debt. So they seem to have a decent liquidity position to keep funding those growth investments. Looks pretty healthy for a company in this kind of expansion phase.
Okay, so operationally undeniably strong. But like we said at the start, the market reaction wasn't just about these positive numbers. Let's pivot to their strategic outlook and guidance. This seems to be where the story got a bit more complicated for investors.
Yeah, this is really the nub of it, isn't it? Why the caution? A key factor almost certainly was that they reiterated their full year 2025 guidance.
Meaning they didn't raise it.
Exactly. Despite that strong Q2 beat we just laid out, the guidance for the full year stayed the same. Revenue still expected between €1.160 and $1.190 billion. Adjusted diluted EPS still 0.50 to 0.54. Adjusted EBITDA still 288.5 to 301.8 million.
And that often signals what? Cut to the market.
It often signals that management sees something coming in the second half, maybe some headwinds, maybe a bit of deceleration that offsets the Q2 outperformance. Even if this quarter was great, they're not ready to promise more for the full year.
Okay, so the big question then is why maintain guidance after beating? What changed in their assumptions that's now baked into that outlook?
Well, they did give some updated assumptions within that same guidance range.
Like what?
For instance, they now see the BDS segment growing by high single digits for the full year. Okay, that's strong. But they now expect the engineering segment to decrease by low double digits compared to last year.
Reflecting those delayed orders moving into the second half.
Precisely. But on the flip side, a positive update. They increased the projected HVS share of total revenue, now expecting 40 to 42%, up from 39 to 41% previously.
So more confidence in that key growth engine.
Exactly. That's a strong positive signal amidst the overall caution, shows that core strategy is working even better than planned.
Okay. And what about those macro headwinds everyone's always worried about? Tariffs, FX, that sort of thing?
Yeah, they addressed those directly. They noted the EU to US tariff rate assumption is now 15%, up from 10% before. That's a pretty big jump.
5 points. How are they handling that? Did they lower guidance because of it?
No, and this is key. Management stressed that this extra tariff impact is fully absorbed within the maintained guidance.
Fully absorbed.
Through, well, a few things. Positive customer talks, using their global factory network to optimize logistics, maybe some modest price tweaks or changing shipping terms, those Incoterms.
That's impressive navigation.
It is. And crucially, they said they haven't seen customers pulling orders forward in a big way because of the tariffs. Suggests demand is pretty stable, not just a reaction to potential price hikes.
Okay, absorbing a 5-point tariff hit is quite something. Any other financial currents they mentioned?
Yep, there's also foreign exchange. They expect a currency headwind of about 12 to 15 million on revenue in the second half, assuming the euro stays around 1.13 to 1.17 against the dollar.
And that's also absorbed.
Apparently so. offset by organic growth and hedging strategies, they said.
Okay. Anything else on the financial front impacting the outlook?
One more thing, taxes. They expect a higher tax rate for the year, around 25.8%, mainly due to being cautious about using some deferred tax assets in Denmark as they optimize things there.
So that higher tax rate eats into the bottom line a bit, even with good operating profit.
Exactly. It offsets some of the operating profit improvement when you get down to net income and EPS. So, it's another piece investors have to factor in. It really does sound like they're juggling multiple balls to keep that guidance intact.
A sophisticated balancing act, for sure. Okay, beyond the numbers and headwinds, how are they physically building for the future? Let's talk operational footprint, capacity expansion.
Right. This is where you see the long-term vision really taking shape. They're investing aggressively. Just secured about $200 million in new financing in July, specifically for this.
Where's the main focus?
The Latina facility in Italy is a big one. It's now gross profit positive, which is a milestone. They're ramping up commercial production, especially for high-value syringes.
Syringes, any specific types?
Yeah, they mentioned customer validations for more dual-chamber pre-filled syringe lines going into 2026. And Latina is also gearing up for high-volume, ready-to-use cartridge production, late 26 or early 27. It's a steady build-out.
And what about the U.S.? That's a critical market.
Absolutely. The Fishers, Indiana plant, well, it's not profitable yet, but they say it's showing sequential improvement. Installations, customer validations are ongoing.
What's the timeline for Fishers?
The target is full productivity by the end of fiscal year 2028. The plan is for it to serve the majority of the U.S. market eventually. Huge strategic importance for capturing U.S. demand and supporting onshoring trends.
So a multi-year ramp up there.
Definitely. And meanwhile, their Denmark site is pivoting. It'll become more of an innovation hub, focusing on custom manufacturing lines for device assembly, packaging.
Interesting. Any other footprint moves?
They're looking at a second site in Bologna, Italy, possibly for more optimization, maybe access to technical talent there. So yeah, they are clearly playing the long game, pouring money into future capacity and innovation.
Okay. Switching gears, slightly market dynamics. What did they say about vial demand? That's been a bit volatile lately, hasn't it?
It has. But they sounded more positive this time. They observed encouraging signs of stabilization in vial demand. The destocking seems to be easing off.
Any hard data on that?
Order intake for vials showed strong double-digit growth year over year. That's a good sign. They're sticking to their confidence in mid to high single-digit growth for vials for the full year 2025, moving towards normalization.
That's good news after some of the headwinds there.
Okay, connecting this back to the bigger picture. Biologics. Clearly a massive long-term driver for their high-value stuff. Any specific areas within biologics they highlighted?
Yeah, definitely. So GLP-1s, the big weight loss drugs, they see those as a solid long-term tailwind. But interestingly, they noted GLP-1s mainly use syringes and cartridges, not so much vials. Okay, so HVS is well-positioned there. What else?
They highlighted a really robust pipeline in monoclonal antibodies, MABs, those key targeted therapies, and also increasing requests for special coated vials needed for highly potent drugs like antibody drug conjugates, ADCs.
So it's broad exposure across different types of biologics.
Exactly. Shows the depth. And they also feel well positioned to benefit from pharma companies investing more capital, especially the U.S. onshoring trend. Good for their engineering business and obviously the Fishers plant, as companies want to de-risk supply chains.
Okay, let's try and pull this all together then. Investor context outlook. We've got this picture. Strong Q2 beats, clear long-term strategy execution, especially on HVS.
What a market reaction that felt, well, cautious. Shares went down despite the good print.
Right. So what does that divergence tell us?
It really suggests investors latched onto the maintained full-year guidance and maybe gave significant weight to those newly quantified headwinds with the tariffs, the FX.
Like they focused on the clouds rather than the current sunshine.
Kind of, yeah. It's like the market put on glasses that only saw the unchanged guidance and the macro pressures and maybe missed the bigger picture of fundamental strength and strategic progress.
And yet management on the call sounded pretty confident, didn't they?
Very confident. They kept emphasizing the sustained momentum, the healthy market demand from biologics, from the shift to self-administration, the big trends.
So management sees the long-term strategy, HVS, the big investments in Latina, in Fishers, as the path to sustainable growth and better margins.
That's the narrative. And the near-term catalysts would be things like hitting capacity milestones at those new plants, getting the engineering order book recovering, maybe even beating that already raised HVS mix target.
Plus, they have those established relationships, right? Top 25 pharma customers.
Huge advantage. They stress that for these high-value, critical products, customers care more about secure supply, quality, and that global footprint than just squeezing on price. That's a powerful moat.
Okay, this really sets up a fascinating situation for investors, doesn't it? You have this, you said, unenthusiastic market reaction
We do
to what was objectively a strong quarter. Beat top line, beat bottom line, expanded margins, HVS shift accelerating.
Yeah.
But the street recoiled because guidance stayed flat and they quantified those headwinds even though they said they absorbed them.
Right. Which, this kind of situation, it just screams potential opportunity for maybe a contrarian view, doesn't it?
Okay, let's hear it. This is our not financial advice segment, of course. What's the pitch?
Okay, disclaimer firmly in place. My thinking is, look, the market seems fixated on these near-term bits, guidance nuances, macro stuff that Stevanato actually seems to be handling pretty well through operations and customer talks.
While the core story remains intact.
Exactly. That core business, the secular demand for biologics, that HVS shift to syringes and cartridges, building out crucial capacity in Italy and the US, that's all still very much on track. Remember that full productivity by end of FY28 for Fishers. That implies years of growth the market might be ignoring right now.
Okay, so the long-term picture looks brighter than the current stock price suggests in this view.
That's the thesis. We heard vial demand is stabilizing. Engineering, it's a drag now, but likely recovers as legacy stuff rolls off and onshoring drives demand for their tech.
So what's the trade idea then? How would someone play that view?
Well, one idea, purely illustrative, might be something like a calendar spread. You could look at buying calls, maybe with a strike a bit above where the stock is now, but looking further out, say, January 2026, maybe even March 2026 expiry.
Betting on a longer-term re-rating?
Yeah, betting that once the market digests these absorbed headwinds, sees more proof of HVS growth, sees those new plants humming, the stock gets appreciated more.
Okay, but long-dated calls can be expensive.
Right. So to help fund it, you could maybe consider selling an out-of-the-money put, perhaps with a shorter expiry, like December 2025, below the recent lows.
What does that achieve?
It expresses the belief that the downside from here is maybe overdone, and you collect some premium for selling that put, which offsets the cost of the long calls.
So limits the upfront cost, profits from recovery, profits from time decay on the short put, but still keeps upside exposure.
That's the idea. A potentially lower cost way to play for upside in a quality company that seems to be getting punished for, effectively managing challenges. You're betting on the fundamentals winning out over the next year or so.
Interesting structure. Okay, let's wrap up our deep dive on Stevanato Group's Q2 then. We've seen a company hitting solid financial beats.
Yep, driven by that smart pivot to high-value solutions and big bets on future capacity.
Yet, the market focused on the maintained guidance and those macro headwinds tariffs, FX, even though management says they're under control.
Which creates this really interesting divergence, doesn't it? Management's confident about their strategy and the big trends,
While investors seem to be pricing in more near-term worry.
Yeah, it really makes you wonder, how many other companies are dealing with similar tariff and currency issues, but maybe aren't absorbing them quite as smoothly without hitting guidance. Put Stevanato's execution in perspective, maybe?
Definitely food for thought. Now remember, everyone, this information is purely for discussion purposes. It is absolutely not intended as financial advice.
Please, do your own research. Consult with a qualified financial advisor before making any investment decisions.
But we are curious to hear your take. Given Stevanato's Q2 and their outlook, do you see this market reaction as an overreaction? Or are those headwinds a more significant concern than management lets on? Let us know what you think.
Yeah, curious to hear thoughts.
Thank you for joining us for this deep dive.